Warm welcome guys to another week ahead video. This week's video will cover the trading week running from Monday the 20th to Friday the 24th of September 2021. Now the time for the next FOMC meeting is finally upon us, coming up on Wednesday in this upcoming week. But it is important to keep in mind that a lot of the expectations regarding an official tapering announcement at the September meeting has been dampened, of course, by that August NFP print that we had, where the headline not only missed consensus by more than 500,000, but also missed the minimum expectations by 140,000. Now, the report itself, even though the headline NFP missed, the overall information under the hood wasn't nearly as negative as that headline number suggested. But, the August print was enough to basically see the markets push back their expectations for that official announcement happening in September. It, of course, didn't derail tapering as a whole, because markets do still see tapering being announced in Q4. Most likely right now is of course expected for November at 67% according to a recent Bloomberg survey. But in terms of that August jobs print, what it did do, like we said, it didn't derail tapering as a whole. It just derailed the idea that that announcement will take place in September, where the odds of that now happening is very, very close to zero. Now, do keep in mind that, a tapering announcement in Q4 has already been largely discounted by the market. So the actual announcement, whether that is September, November, December, January, doesn't really matter. It's not a major focus right now. The big question that the markets have isn't when they start, but when they do start, will it be a fast taper or will it be a slow taper? And this isn't really a trivial question because, it has direct consequences for how the market's expectations for the next rate hike by the Fed will evolve. Because think about it this way: if we have a slow taper from the Fed, which plays out at, let's say, 10 billion in treasuries and 5 billion in mortgage-backed securities at a time, that'll see the Fed basically tapering throughout the whole of 2022, probably concluding tapering only in November. That means that the current median expectations for the first rate hike is firmly set in 2023, and that shouldn't change as long as the Fed takes the whole 2022, of course, to taper. Now, if they do decide to go with a faster tapering, possibly concluding that taper by the middle of next year, then that suddenly brings forward the expectations for a possible Q4 2022 rate hike and basically brings forward those expectations. So not a trivial question at all, something that the markets, can really be a big market mover if they do decide to go with a faster one. Now, considering, current inflation data that we've had, I think it's easy to understand both the patience from the doves as well as the angst from the hawks, because even though the numbers are crazy high right now, we have started to see some sizable deceleration playing out. So I think there's reasons to understand both the hawks as well as the doves angst and patience about it. But when it comes to inflation, the Fed isn't really focused on inflation right now, and neither is the markets, because the big focus point, of course, is on jobs. And recall that the Fed has made it abundantly clear previously that they want to see substantial further progress in regaining the close to 10 million jobs that was lost due to the pandemic. And so far, they've recovered fewer than half of that expected number. So the incoming jobs prints, especially the September NFP coming up on the 8th of October, that'll be a key data point for markets to determine when tapering will start, but more importantly, what possible pace that tapering will run out. Now, do keep in mind that this meeting, the FOMC one coming up this week, it will be accompanied by the quarterly summary of economic projections. Now, the consensus expects a slight downgrade to growth projections due, of course, to the Delta variant, but it is also expecting another sizable upgrade to inflation. But again, the markets will be firmly focused not on inflation, not really on the growth upgrades, not even on the upgrades to unemployment. What the markets will be most focused on in this upcoming meeting will, of course, be the updated dot plot. Now, the Fed has done very well in their recent communication to try and decouple interest rate rises from the tapering plan. So whether tapering takes the whole of 2022 or it's concluded by the second half or the first half of 2022, it will be important, as we just discussed. Now, even though the Fed's language at next week's meeting is expected to subtly suggest a tapering decision is coming up in November or December, the bank's biggest struggle, in our opinion, in this upcoming meeting might come from trying to possibly manage any hawkish surprises potentially coming from an updated dot plot which did cause quite a big stir, of course, going back to that June meeting. Now, back in June, only 7 FOMC members projected a rate rise for 2022 compared to 13 members projecting a rate hike in 2023. Now, if we do get just 3 more members from the 2023 median side now projecting a possible first hike in 2022, that would be enough to see the median for the first projected rate hike changing from 2023 to 2022. And that will be a very tough one for Fed Chair Powell to try and manage in his press conference. Now, even though such a move will be seen as a positive for the dollar, we won't expect the same type of strong push that we had coming from that June meeting. Remember that when we had the June FOMC meeting, one of the key factors that aided the dollar's massive rip to the upside was that at the time, we had a very oversubscribed short positioning in the dollar. Now, that built up and stretched short positioning meant that a huge chunk of market participants were basically caught off guard with that meeting, and they were squeezed out of their weaker short hands, which exacerbated the move to the upside in the US dollar. So even though a median dot plot showing a 2022 first hike from a 2023 first hike like the previous one, even if we do see that 2022 hike being the new median, it will of course be a positive for the dollar, but we're not expecting the same type of veracity in the move, the same type of strength in the move like we had back in June, considering that right now the dollar's positioning is firmly in net long territory. And, from a positioning point of view, pre-positioning point of view at least, we are very close to the year-to-date highs around that 93.50 psychological level. So also keep in mind that the dot plot, even though it is significant, it won't be as important as the incoming data like that September NFP print coming up on the start of October, as that will basically dictate what the markets expect from the pace of tapering. So the biggest focus point for this FOMC meeting won't really be tapering, as we said, because right now the expectations for that to be announced is close to 0. We might get that subtle nudge that, hey, we are planning to make that announcement in November. That can, of course, still be hawkish. But the main focus point, given that the actual tapering announcement isn't really considered as a possibility in this meeting, the real focus point will be on the dot plots and whether that median has been able to change from 2023 to 2022. So looking at a potential trade plan for this upcoming week, starting with the hawkish outcomes, if we do see that dot plot, that median expectation change from a median expectation for 2023 to 2022. If that happens, that is expected to be positive for the dollar, positive for yields, negative for stocks, negative for gold. If we do see the language opening up the possibility of a November tapering, so again, we're not expecting them to make an official announcement, but if they do give the markets that unofficial nod saying, in their language that they should be preparing themselves for a potential announcement at that November meeting, even though that is largely expected, it should still be a positive nod, a more hawkish move from the bank. If we do see more concerned language about the possibility of more persistent price pressures, that should also be a positive. Not really expecting that as a baseline expectation. Remember, here we are looking at potential hawkish shifts from the bank. So right now, we're not expecting them to come out more stressed because the most recent CPI showed a sizable deceleration in those core metrics. But if we do see more concerned language about inflation for whatever reason, that is also expected to be more of a hawkish tilt. And if they say that there's absolutely no concern from them for the labor market with that low August NFP print, basically downplaying that miss as mostly delta related, that should also be seen as more of a positive from the markets. Then in terms of dovish outcomes, if we see that dot plot median remain in 2023, i.e. we don't see the 3 additional votes voting for a 2022 hike, if it stays, the median stays in 2023, that is expected to be more of a dovish tilt from the bank. It shows that even those more hawkish members, it wasn't enough. The most recent data wasn't enough for just 3 more members to change their mind. So that should be seen as more of a dovish tilt. If we do see the language stating that talks of tapering right now, even at the November meeting, might be premature and more time is needed, that can also be seen as a dovish tilt. So imagine if Fed Chair Powell comes out saying that, yes, we have made progress on inflation, But with that August print, guys, we need more time, we need more data before we decide anything on tapering. That means that we won't even see that unofficial nod of a possible announcement coming up in November. And that can also be seen as a dovish tilt from the bank. Apart from that, if they say that the recent CPI basically just justifies the overly patient stance on price pressures, that should also be seen as more of a dovish tilt from the bank. And then furthermore, if they voice real concern over that August NFP print saying that, hey, under the hood, we are seeing bigger issues develop for the labor market going forward, that is, of course, also will also be seen as a more dovish tilt, because remember, right now, the big focus for the Fed and thus the market is what happens to the labor market. There's not as much focus on price pressures as there's the labor market. So if they come out being overly concerned and stressing more patience is needed from a labor market point of view, then that of course can also be seen as more of a dovish tilt. And in that scenario, in all of these scenarios, we would expect to see downside in yields, downside in the dollar, upside in stocks or S&P, upside in gold. Now remember, what can oftentimes happen in some of these meetings, you might get one or two of these hawkish outcomes, but then might also get one or two of the dovish outcomes at the same time. Now when you get those types of outcomes, it's really not an ideal environment to trade, because there can be some positives, some negatives. What we want from the base tradable opportunity is we want to see a overly hawkish tilt and an overly dovish tilt, meaning, at least two or three of these metrics to create a real sizable move. And again, keep in mind that going into this meeting, we're not expecting the same type of push in the dollar like we had back in June. Because remember, positioning played a real big part in that big flush to the upside. So we want to be just cautious that even if we do see that dot plot moving from 2023 to 2022, even though that is expected to be positive, it's not expected to be as positive as we had with that June meeting, due to, of course, where positioning is right now. And, just looking at the technicals, we are running up into some very key areas of technical resistance. So all important things to keep in mind, looking at overall pre-positioning going into any event, especially this FOMC, is very important. If you have strong pre-positioning, it could lessen the impact of an overall hawkish or an overall dovish outcome, and could potentially sometimes trigger a buy the rumor, sell the fact reaction. So if we see a significant hawkish positioning going into the event, i.e. downside stocks, downside gold, upside yields, upside dollar, so the market's positioning themselves for a hawkish outcome, that could lessen the impact of a hawkish outcome. And if you see a significant dovish positioning, i.e. downside yields, downside dollar, upside stocks, upside gold going into the event, that could possibly lessen the impact of an overall dovish outcome. So pre-positioning always very important to keep in mind for these types of events as well. All right, guys, so that's everything from our side. As always, good luck in trading that event, and any questions, don't hesitate to let us know.